Hello and welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. We just want to verify the audio. We had trouble with the audio earlier today. Daily Webinar Series. Sounds like the audio is working. Please let me know if the audio is not working. As always, thank you so much for joining. We want to go over a topic before we get into the questions, but we definitely want to use today's time to go over questions or topics that you might want to discuss. So feel free to chat over any questions or topics, and we can go over those topics or questions. As always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we want to use today to talk about the options for Vanguard solo 401k account holders. So we want to put it in context here. So Vanguard exited the solo 401k industry last year. They sold their solo 401k accounts to a census. So they still promote solo 401k plans on their website, but they're just sending you over to a census. So if you had a Vanguard solo 401k plan, your account was transferred to a census. So there's still a lot of individuals that, some individuals, they immediately wanted to get away from Vanguard and a census. They used the opportunity to upgrade their plan to our plan last year. But just because the account ended up transferring to a census doesn't mean that you can't still move away from a census. You definitely can. And there's a robust process to transfer from one solo 401k provider to another. The name of that process is a restatement. So just to clarify, when somebody converts their solo 401k plan from one provider to another, they're not shutting down their solo 401k plan and then starting up a new solo 401k plan. Instead, they're restating their solo 401k plan. So the way that I think about it is a cut and paste. So someone has a solo 401k plan at a particular institution, like Vanguard, which then gets transferred to a census. That means that their account is at Vanguard and then it gets transferred to a census, and the plan documents are provided by a census/Vanguard. So they can then replace those account documents, because what creates a 401k plan is the documents, right? A 401k plan is a legal entity. So like any legal entity, it's the documents that create it. So anytime someone is upgrading their plan from one institution to our plan, what they're really doing is they're replacing the documents with our plan documents. Now, we don't hold or have access to any of our customers' money, so they have to have their accounts somewhere else. So they wouldn't be able to have if somebody has a plan that was at Vanguard that got transitioned to a census, they're not going to be able to keep their accounts at a census. But let's say you had a solo 401k plan at Fidelity or Schwab, where you had the plan documents from Fidelity or Schwab, and then you upgrade to our plan documents, well, you can still keep your account at Fidelity and Schwab, because Fidelity and Schwab will open up accounts for third-party plan documents, whereas a census doesn't do that. So in all cases, it's a restatement. The plan continues, but now it's governed by our plan documents. So if you had a plan over at Vanguard that got transitioned to a census, because Vanguard sold their business to a census, you could still upgrade to our plan and then take advantage of all the service and features of our plan. So we want to spend a moment to talk about what that process would look like and what are some of the considerations. So let's first start out with some of the considerations. So this is a good slide, as it gives us some of those high-level considerations. So number one, what are the reasons that somebody would want to transition from a census to our plan? Well, the mega backdoor Roth. So the Ascensus plan, it doesn't support the mega backdoor Roth. Like if you had an account at Vanguard that got transitioned to Ascensus, it's not going to allow for mega backdoor Roth. So mega backdoor Roth means that you have a plan that allows you to contribute Roth and after-tax contributions all the way up to the overall limit. For example, $70,000 for 2025. And it's a specific process that you have to go to, because what you're technically doing is you're first making an after-tax contribution, because those after-tax limits are so much higher than your standard Roth 401k limits. If you have the self-employment income to justify it, you can make those contributions all the way up to the overall limit. Step one, then step two, the funds are moved over to a Roth solo 401k. So it's a two-step process. The second step is reportable when you move the money from the after-tax solo 401k account to the Roth solo 401k account. So we have a plan. We have a plan documents that allow you to do that. We have experience, deep experience. We're the leaders in the space as far as making mega backdoor Roth solo 401k contributions. And we provide the support. For example, that 1099-R that I mentioned, we handle that as an optional free service for our customers. So that would be a top reason. Another top reason would be investment options. So if you had a solo 401k plan that was at Vanguard and then got transitioned to Ascensus, you're going to be limited to certain Vanguard mutual funds in terms of your investment options. Whereas with our plan, it's totally open architecture, including alternative investments. What does that mean? That means that you can open up an account at a place like Fidelity, where you're going to have a wide range of investment options through Fidelity, whether it's mutual funds, ETFs, stocks, bonds, etc. But then on top of that, because our plan documents allow it, you can also invest in alternative investments, such as true alternative investments, such as crypto, real estate, private placement, private stock, etc. So that's a big difference. Solo 401k loans, that's another huge difference. So with Ascensus's individual K, so if you had a solo 401k at Vanguard that got transitioned to Ascensus, it's not going to allow for solo 401k loans. So if you want to be able to access money in your solo 401k account as a loan, it could be for an emergency purpose, it could be for any purpose. If you just leave your solo 401k at Ascensus, you're not going to have that feature. Whereas with our plan documents, it certainly does allow for solo 401k loans, where you can borrow up to 50% of the balance, not to exceed $50,000, use the money for any purpose whatsoever. It needs to be documented as a loan, and it needs to be paid back according to the loan terms. And if yes to both, it's not going to be subject to taxes or penalties. We document the loan as part of our service for no additional charge. The terms are that it has to be paid back in monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. Annual fee, that's another big difference. So if you let your Vanguard solo 401k transition to Ascensus and you still have it there, Ascensus's pricing policy is $20 per participant and $20 per mutual fund. So if you have two participants, like a husband and wife, they're each invested in 4 mutual funds, then you're looking at $20 per each participant and then $20 for each mutual fund. So they can quickly add up. Whereas we charge a flat annual fee of $125. We help our customers open up accounts at the bank or brokerage of choice. For example, Fidelity, for example, Schwab. With those brokerages, they don't charge anything to open up the account. Those brokerages are not charging a maintenance fee. They even have free online trading. Alternative investments, the compliance support, these are all additional big differences, right? So we mentioned the 1099-R, for example. If the value of the plan goes above $250,000, there's going to be an annual 5500EZ filing requirement. That's something else that we handle as an optional free service for our customers. The tax credit. So our plan will make the self-employed business eligible for $1,500 in solo 401k tax credits. And it's not just limited to new plans. So that means if you have that existing solo 401k at Ascensus that was transitioned from Vanguard, you could upgrade to our plan to include the automatic contribution feature that's needed to qualify for the tax credit. So if the plan is restated here in 2025, the self-employed business would be able to start claiming those tax credits when they file their 2025 tax return, $500 per year for 3 consecutive years. What's needed is to have the automatic contribution feature selected in the plan documents, as well as the required notices and other forms, which we prepare automatically for all new clients. So for existing solo 401k, Vanguard solo 401k plans that were transitioned to a census that are upgraded to our plan, we're automatically going to include it. The self-employed individual, the solo 401k participant, has the right to opt out of that default 3% contribution percentage that has to be set in order to make the plan eligible to claim the credit. So opting out of the default, though, doesn't mean that the self-employed business can't claim the credit. Just because they exercise their right to opt out of the default doesn't mean that the plan doesn't have the required automatic contribution feature. Doesn't mean that the plan doesn't have their notices and other forms. Therefore, the self-employed business would still be eligible to claim the credit. And then with the last point, again, just to highlight that unlike a Vanguard plan that's a transition to a census where it's going to be stuck at a census in terms of you can't open accounts at other places, we are totally neutral. We've helped customers open up accounts at hundreds of different banks, brokerages, cryptocurrency and alternative investment platforms, etc. Now, one thing I will also highlight, the transfer process. We've kept our community updated as far as that process. Unfortunately, a census hasn't made it the easiest to transfer, but it has definitely improved. It's even noteworthy that there's even plaintiffs' attorneys out there potentially putting together a class action against the census. Hopefully things will just improve and the accounts can transfer over in a streamlined fashion. As I mentioned, we're very hands-on in helping our customers transfer those accounts over. We have a wealth of information. We just keep the whole community updated as far as the latest information in terms of the process. It does seem that has certainly streamlined relative to the beginning. When the accounts were first transitioned over, there definitely were some hiccups, and it seemed that a census was changing the process, but it seems to at least stabilized, and it's been a consistent process for some time. But with all customers, again, we're very hands-on in helping them open up accounts at the bank or brokerage of choice, helping them with the transfer, whether it's from the solo 401k account at a census, or if there are other retirement accounts that they want to roll over, such as funds in a former employer plan or a non-Roth IRA. So certainly don't hesitate to ask questions about this. Come to our community. We have forums where people can post questions 24/7. So there's definitely a number of forums going on about this whole census Vanguard population. You can join at mysolo401k.net/my community. We go live twice a day. You can subscribe on our YouTube channel and you get the notifications. If you subscribe and hit the notifications bell, then you get the notification and you can jump on a session. Again, we go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. You can also find the schedule at mysolo401k.net/webinar. If you sign up on that page, then you'll get a recording link later where you're able to watch it later. So there's a lot of great ways to learn and to share the knowledge. So with that, let's see what questions we've got. Thank you so much for bringing the questions. If I contributed $31,000 in my day job, can I also put $70,000 into my after-tax plan and then convert to my Roth? So at the end of the day, I have $101,000 in my Roth. So thank you so much. That's a great question, and it's a common scenario that someone might have a W-2 job and even participate in their W-2 employer-sponsored plan, and then also have a solo 401k. So as long as that individual is self-employed, has separate self-employment income, and there's no non-owner, non-spouse W-2 employees working for any business owned by that person or a spouse, if any, they're going to be eligible to set up our solo 401k plan. And most certainly, our plan does allow for after-tax contributions and then transfer to a Roth solo 401k. So that secondly, as long as they have the self-employment income to justify the contribution. So for example, they have at least $70,000 of self-employment income. What self-employment income is going to depend on how their business is taxed, right? Let's say their business is taxed as an S Corp. Then they would need at least $70,000 of W-2 wages from their S Corp. They can contribute 100% dollar for dollar of that self-employment income as a voluntary after-tax contribution and then transfer to the Roth solo 401k. So it's not reduced. So you're exactly right. It's not reduced by contributions made to a day job 401k plan. So as long as that day job plan is not a 403B, the fact that the person contributes to that day job 401k plan is not going to reduce their ability to make voluntary after-tax contributions. So again, as long as they have that self-employment income to justify the contribution, then yes, they could contribute all the way up to the overall limit, $70,000, and then move it over to the Roth solo 401k. Now, of course, the funds are going to be in different accounts, and they would have, in this scenario, just to be clear in the way that the question was phrased, the contributions to the day job plan would be in the day job 401k plan. Whether the day job 401k plan allows for Roth contributions is an open question. But certainly the $70,000, assuming the person's self-employed and has the self-employment income, that would be in the Roth solo 401k. We would help the person set up the requisite number of accounts. We would handle the 1099-Rs and optional free service. In other words, no additional charge. Thank you so much for the good question. Next question. I really want to know if I open a 401k with you, am I allowed to open a brokerage account and have like Fidelity or Schwab managed for me, and I can get enough to buy real estate take back over? Great question. So most definitely, we're neutral as far as where the account is at. Fidelity and Schwab, those are the top options. We've got thousands and thousands of people that we've helped open up accounts at Fidelity and Schwab. Number two, you can definitely have an advisor help manage your money. We have, for example, we work very flexibly, right? Whether it's an institutional account. So sometimes the advisors will custody at a specific institution like Fidelity. So it might be a Fidelity institutional account as opposed to a Fidelity retail account. So we'll help with the requisite paperwork. Same thing with Schwab. Schwab's got different sets of paperwork, whether it's retail or institutional. So you want to ask your advisor. Now, sometimes the advisor can also help manage the money, even if it's a retail account. So those details, of course, will depend on the advisor that's helping to manage your money, but we are totally compatible and flexible. Moreover, once the individual has grown the account to a certain amount, then yes, they can then take the money out of the brokerage account and start investing into alternative investments, or you can have both, right? Bank and brokerage accounts. Most people who want to invest in alternative investments want to have a bank account because it makes it easier to access the money for those alternative investments, right? Because now you get access to certified bank checks. Now you get access to a debit card. You can easily ACH money in and out of the account. And you can have both, a bank and a brokerage account. Obviously, it's got to be within the solo 401k real estate investing rules. So it's got to be a passive investment. The real estate would have to be, if it's a single family rental, for example, would have to be titled under the name and the EIN number of the plan. And we field those questions every single day in terms of educating our customers on those solo 401k investment rules, whether it's real estate or other types of alternative investments. Thank you for bringing the good question and scenario. So as mentioned, we go live every day. So please subscribe, hit the notifications bell, then you can get notified. If you're on YouTube, please you can also register at mysolo401k.net/webinar. Please come to our community. We have a vibrant forums. We have over 30,000 members. So it's a great place to learn, to see what other people are asking, to come and ask your own questions. It's totally free. All are welcome. It's not just for customers, for example. All right. Well, thank you so much for the good participation. We appreciate it. Until next time.